Good morning, good afternoon, good evening. Welcome to the Supply Chain Risk Management Consortium's fifth in a series of webinars on creating company growth by leveraging the risk landscape and building a resilient enterprise. And what we're focusing on today is unleashing margin opportunities in a stagnant marketplace, which we're living right today. So I am the host of the webinar, Jim DeVries, and we look forward to your feedback throughout the webinar. Our supply chain readiness assessment takes less than 30 minutes, and that link is in this webinar. And we want to help you build that resilient enterprise. We appreciate you taking the time today to discuss this important topic on building a resilient enterprise, and we hope that your family are healthy and safe. This is the fifth in a series of webinars that we've covered on building a resilient enterprise. We started back in November on strategic geopolitical risks, which are foremost out there today. Then we said, well, how can you get finance and supply chain results? How can we get good dialogue between those two worlds? And then we went into mitigating geopolitical risks at the tactical and operational level, really got jiggy, as Greg would say. Then we got into making real-time supply chain risk decisions. And today we're talking about how do you create growth in your company while leveraging the risk landscape. We got plenty of risk out there in the landscape. So let's look at how do we deal with that. Your feedback is very important to us. So please do log into polev.com 073. It's in the chat. Also, the chat is open and the Q&A is open throughout. Please enter any information that you would like more on. Again, my name is Jim DeVries, president of Enhance International Group. And with us today, we have Greg Schlegel, who is the founder of the Supply Chain Risk Management Consortium, delivering education, webinars, workshops, and consulting. So Greg, a few words of intro.
You bet. Thanks, Jim. Pleasure to be here with you today to talk about our passion, which we always talk about in terms of risk, but today with a little different twist. So I am the founder of the Supply Chain Risk Management Consortium. We've been in business for about 14 years. I've been I guess a career academician. I've taught supply chain management and risk at 6 universities here in the US. Been a former IBMer, supply chain executive consultant, spent 30 some years as a Fortune 100 supply chain exec. And ultimately, I'm kind of a poster child for APEX, now ASCM, which 45-year member, and essentially culminated in becoming president of the organization back in the late 90s. Back to you, Jim.
Thanks, Greg. A little bit of my background. My core belief is that success starts with discovering the untapped potential of the employee, from leadership all the way down to the shop floor, including suppliers and customers. So how do we get that untapped potential out there so that we can all create win-wins? And my belief is that we live in an ecosystem, and it's in developing others we can excel at building the resilient enterprise. With that, we'll go through the deliverables today. The first is finding opportunities in a multipolar polycrisis. That's what we're living, is this multipolar polycrisis, where we've gone from globalization to deglobalization. So we'll talk a little bit about that. We'll explore some different restructuring growth models that are out there. We'll get into some case studies with aligned benefits on how to take advantage of the risks out there, and then building out your long-term roadmap to success. And we're addressing that challenge of how to transform that risk into margin growth for your company So as we see top line growth uh, dwindle, so to speak, or be ebbed, I would call it a bit, how do we create margin growth opportunities? With that, Greg, an introduction of your company.
You bet. We said we'd talk a little bit about uh, who we are and what we do. We are 32 companies. That represents about 1,700 supply chain risk professionals around the globe. We operate in 23 different companies through partners, through event planners, and so forth. We have 3 pillars. You can see them on the right. We do a lot of education, workshops, courseware, and so forth. We do a lot of consulting, lead, guide, direct, and coach. And then on the right-hand side, we have a host of software as a service, cloud-driven software that supports our vision of supply chain risk and resiliency. On the left-hand side are what we call our product lines. We have online education. We have 2 certificate courses. One is basic. They're self-paced. You move on, there are videos and so forth, articles, quizzes. The other is geared pretty much around public health care, supply chains, and service organizations. So we have 2 certificate courses. We have 2 online assessments. One is supply chain management readiness assessment. We're going to talk about that in a little more detail today. The newest online assessment is Pure Risk. It's supply chain risk and resiliency. It goes through questions of discovering using AI ML algorithms, and it kind of gives you graphical pictures of where you are in a supply chain maturity curve, what your risk appetite is, and what your risk culture is, and gives you some action items. We do a lot of coaching and consulting, and as I mentioned, we have a host of heavy-duty software as a service companies to do the heavy lifting, to map your supply chain and so forth. So with that, that's basically who we are and what we do. Back to you, Jim.
Thanks, Greg. And just a bit of background on EIG. EIG is a company of 50 plus providers, consultants, consulting companies, and we're focused on enabling your enterprise. EIG serves as a master integrator for you to assess the best and the brightest companies. And synergistically, our team is dedicated to empowering your organization's workforce by leveraging our partners' tenured expertise. Our goal is to provide collective, collaborative, experience, thought leadership to enable organizations to deliver self-sustaining margin growth. As you can see, we have the bicycle slide. We cover this every week. We're really working on discovering risk opportunities throughout your supply chain end to end. And so we'll just move on to the agenda today for creating growth by leveraging the risk landscape. First, we're going to define the dynamic change in globalization. So as we said at the top, we're in a multipolar polycrisis. So we're going to get into that a bit. Then we're going to introduce the tools and the risk reward opportunity growth matrix. And then we're going to get into creating growth by leveraging the risk landscape, get into some examples, tools, more details, and then to the case studies. And then we'll say, well, what can you do now? And guide you a bit on that. And then our roadmap and takeaways. With that, we'll get into defining the risk landscape. So we're going to start off with going to the GDP, gross domestic product, from the Bureau of Economic Analysis. And as you can see here, tracking GDP from last year, 2024, well, 2022, I should say, Q4, all the way through last year. We saw a significant increase in GDP. It almost doubled in Q3 last year and then has now ebbed down a bit. Just so we're all on the same page on what we're talking GDP, according to The definition from Investopedia, it's the total monetary or market value of the finished goods and services produced within a country's borders in a specific time period. On a broad measure, it's the overall domestic production, and it functions as a comprehensive scorecard of given a country's economic health. So we all ramped up in Q3. We thought maybe we would be going at that rate. That was a slug in the economy, and now we're trying to settle out. And that's what's happening out there is companies geared up for that growth, and now we're coming down off of that. That is one of the big drivers going on here. We expect to be settling in at this rate, that 2% GDP rate. With that, I'll turn it over to Greg.
You bet. Thanks, Jim. This is GEP's JEP's Global Supply Chain Volatility Index. Wanted to share it with you. You're looking at April 2023 to April 2024. What does it profile? It profiles excess capacity or lack thereof within several segments of our global supply chain. So anything above on the y-axis, anything above zero implies that the supply chain elements are being stretched. Anything below zero implies somewhat of an excess capacity across the supply chain. As Jim pointed out, we're witnessing somewhat of a lull going into the second, third quarter of 2024, driven by GDP reduction around the globe. And so time will tell, but we wanted to share this with you and make you aware that this is out there and you can take a look at it. All right, next. This is something we call transitioning from global to regional supply chains, all right? This is somewhat of a classic bullwhip effect, but in reverse. How so? All right. Well, it depicts our sense of the impact of deglobalization, which is going on now, due to the process of what we call multipolar global reorganization. Let's take a look. First, on the upper axis, upper x-axis, we have what? Crises, container imbalances, conflicts, de-risking by companies, and even on the far end, on the right-hand side, do-it-yourself supply chain reorganizations. Next, on the y-axis on the left, we have demand and supply issues. And then on the horizontal bottom x-axis, the blue boxes, we have major supply chain phases from our point of view. So from left to right, in the middle of the chart, we have our bullwhip effect and the possible supply chain transformations needed for you to survive and thrive. So let's just take a look at some of them and then we'll move on. From a container imbalance point of view, you can start to see that sometimes you'll have over demand and undersupply, and other times you will have under demand and oversupply. So what do you do in this response phase? We've found that successful companies tend to reduce their product portfolio, which are their stock keeping units, finished goods. We'll talk more about that in detail in a moment. And or they start to rescale their supply chain based on the imbalance. Next, in international conflicts, those are black swan events. We can't control them. But as you move through these events, you might still want to reduce the number of stock keeping units. Go for the gold, all right? You might have to reinvent your product portfolio, meaning you have new channels and new customers. So it's rather exciting, also potentially unnerving at times. As you move forward through the three phases, de-risking through regionalization, that's going on now. So the net from us to you is during this situation, you might want to think about reducing your product portfolio, maybe rescaling your supply chain, maybe even reinventing with new products to new customers and new channels. So we wanted to just share that with you before we give you a little bit of levity in the morning. So Jim's going to give us a little levity here.
Who is this man?
I'm her
He's
godfather.
hardly related.
Get back!
Who is this man?
I'm her
He's
godfather.
hardly related.
Get back!
The net here, folks, with a little bit of levity from the Dial of Destiny movie is you just don't want to be at the end of the bullwhip, all right? Because it stings, all right? And so when we talk about the bullwhip in reverse, that's what's going on right now. We wanted to give you a sense pictorially of what we're talking about in terms of the reverse bullwhip effect, and that you don't want to be at the end, because if you're at the end and you don't have any solutions, it could be a stinging of effect. So we just wanted to inject a little levity there, and I'll turn it back over to Jim.
Thanks, Greg. Appreciate it. Hopefully people enjoyed the video and the sting of the bullwhip effect that you can see on the screen versus what they might feel in the workplace there. So that brings us to our next section on the risk reward opportunity matrix. And this is something that Greg and I have been working on as to describe, how do you maximize your opportunities when you're looking at risk versus reward? So this is a graph we put together, a chart, a matrix we put together. And in here you have reward starting from very little to immense, and risk going from negligible to major. So obviously, most people might say, well, where there's major risk, we don't want to even play in this column at all, or either of these two columns, and we avoid those conversations. And what we're saying is actually this is where the opportunity is. And what you'll find is the companies that are able to identify these issues, these events, or these scenarios, these situations, and then act upon them quicker than their nearest competitor, what, as Greg would say, those are the winners, those are the leaders. Or if you are going to be a laggard, you wait until everybody else solves it and then you tag along. That's going to put you only looking at these types of events down here in the bottom left as, oh, well, we saw somebody else fix it. So it's going to give you some return, but by the time you hit and speak to your customer, what's going to happen? They're going to say, well, your competitor has been doing it for 2 years. So if your competitor is saying, yeah, we've already addressed it, the competitors have addressed it, your customers are telling you that they've already addressed it, and that's a normal dialogue, that means you are in this left-hand corner. Whereas you look at the leaders, that's where they're at. They're in the upper right-hand corner. So how does this relate to how a company operates? Well, most of the time you have a group of products and services, and we're going to go back to the new product life cycle or product life cycle for a product, and you look at the market share. In the beginning, you have very slow growth on the y-axis in market share. You don't have any, the market is not that big, and you're trying to go into that market. Now, when you're developing a new product, that new product is immature. It may be hard to make money on it. The cost may be higher than what you're able to sell it at, but you're trying to broach into that market until you hit fast growth. Now, fast growth is what NVIDIA is going through right now. They're going through that fast growth. We saw a lot of startup companies through the pandemic, like zoom off into this fast growth, and they said their market value of their company is much more than what they actually are. And then at some point in time, it ebbs and flows. So the market value of Zoom is much lower now than it was a couple of years ago. And so you hit that point of inflection of slow growth and then over to zero growth. And once your product hits zero growth, you're pretty much over with that product. It's pretty much commoditized. And the only way to prop it up is with other products or completely redesign the product and retire that product like a BlackBerry and into the next generation S curve. So you have what we call a jumping of S curves. Now, all throughout this process, there are risks, and how you manage those risks throughout this, how you manage the risk of your portfolio of products is what we're going to be talking about next. So with that, Greg.
Yep, you bet. Thanks, Jim. This is kind of our basic concept of risk management, but we've turned it a little bit on its head. Essentially, it's the classic 2x2. On the y-axis is risk from low to high, and on the x-axis on the bottom is reward from low to high. And so let's talk about the four quadrants. On the top left, the red, all right, essentially is very undesirable. Why? Because it's got high risk and low reward. Down the bottom in the yellow, all right, a little different. It's somewhat undesirable because it's risky, but it has low reward. Over in the bottom right, the green, somewhat desirable, it's risky, and it has a higher reward for you. And then finally, up on the top right, we call it very desirable under this premise because it's high risk and high reward, all right? And so what we're trying to do is give you a sense of risk appetite, risk frontier, and especially the concept of leveraging risk to grab that reward before your nearest competitor. So the dotted line, what's the dotted line? Well, that's where essentially it's a hypothetical line where a company might operate and move, as Jim said, move up this curve. It's not an S curve, but it's a curve of risk reward. All right. Every time something comes up, how do you handle it? And, you know, it's hypothetical. Then we have another dotted line that essentially gives you a sense of how heavy industrial companies tend to move up the line. As you can see, as Jim mentioned, this is kind of a little bit of a shift downward from risk and reward based on, you know, relative to the hypothetical, because, you know, heavy industrial companies tend to be a little more conservative. We have another one for you, another dotted line that through our analysis over 14 years, essentially giving you a different shift in the curve, as Jim mentioned, for the high-tech industry. They tend to be shifting off that curve to the left and operate at a higher risk-reward level. So we wanted to just give you some grounding based on this concept of the new concept of leveraging risk to garner additional reward. So we have a few others.
Yeah, just before we get to that,
chart.
Greg,
Yep.
A question in from the audience
Sorry.
on, does the reward come from taking a risk or from finding the mitigation faster for a risk?
It's a good question. All right, two different threads associated with the same risk. You can, based on your risk appetite, we have seen our clients and others attempt to mitigate a risk for, let's say, a project, to make sure that the project or product introduction is successful. The other thread is where you get, I'll say, very aggressive, and you see the high risk and you act on that risk to get that reward, like garnering market share before your nearest competitor. Good question. Two different tactics. Hopefully I answered the question.
Thanks, Greg. Perfect.
Mm-hmm.
I don't have anything better to add. We'll go on.
That's fine.
Answered.
We're here to talk about this new concept. All right, what are we looking at here? Well, this is just a quick share from us to you about our risk appetite and the risk appetite perspectives. This is what we've, put together for the last 14 years. There's really only 4 perspectives that companies take regarding risk. We're thoroughly convinced, and so are the pure risk folks in finance. We've had a lot of discussions, and this is what is in some of our online assessments. But let's take a quick look. On the y-axis, you have 0 to 1. All right. Any risk approach below the 0.5 number that you see halfway through, companies tend to look at risk as a negative. All right. And they become somewhat risk averse. Anything above the 0.5 is where companies tend to look at risk as opportunities. On the bottom x-axis, you have risk decision tactics that support the 4 perspectives. You could do nothing down on the bottom. Loss control, meaning I'm very, very conservative. I don't want to do anything that will pose a loss. Another one is risk steering, where you do balancing between cost benefit and risk reward. Diversifying is essentially you're going to try to diversify, spread the risk across multiple assets and projects. And then finally, the other tactic is risk acceptance. So there are the 4 perspectives: pragmatists, conservators, managers, maximizers. Let's just give you a quick thumbnail sketch of each. On the pragmatists, those are the orange folks. They wait until the very last minute to decide. Basically, they're reactive, associated with a risk. Another one, the dark blue, conservators. Their biggest concern is avoiding a loss. They're very careful looking at projects and opportunities to avoid a loss to the bottom line. Very conservative. The light blue are managers. They're carefully balancing risk reward, cost benefit. They use a lot of tools and techniques to quantify the risk, and then they make a decision. So they try to balance the risk reward. And then finally, maximizers up on the top right, they're big risk takers. They look at big risks equal big rewards. Let's go after it and grab it, like a market share, kind of garnering market share before our nearest competitor. So we wanted to just get you grounded on the risk perspectives. All right. And then after that, we're in our 3rd section. We call it creating company growth by leveraging the risk landscape. And I'll turn it over to Jim.
Thanks, Greg. So we'll get into a little bit of, as Greg said, our overall goal is to create company growth by leveraging the risk landscape. We'll get into those 3 areas that Greg mentioned, and maybe a couple more on proven top and bottom line growth methodologies. These are tried and true: product portfolio management, customer segmentation, and total cost to serve. Greg will do a detailed explanation in a few minutes on those. Before we get into that, let's discuss for a few minutes actions to prevent, avoid, mitigate potential future margin losses. And we talk about margin, we're really just trying to say we don't want to look purely at cost. We want to look purely at top line. We want to look at all 3 perspectives at where there are potentials to mitigate risks, both within your 4 walls, within your suppliers, with your customers. So mitigating that product risk, resulting in increased revenue in the company. So creating scenarios where you're taking advantage, as Greg said earlier, you're taking advantage of a risk that you see out there in the field, and you're changing the product's performance in order to take on that risk. And you take that risk on within your product or in your offering, how you deal with your customer, could be a combination of those things. Then you become more of a leader, a natural leader with your customers. So you're not going to be a follower in that case. In your products, you'll be able to take advantage of that fast growth in the part of the S curve that we talked about before. We know that the first folks into the S curve, generally Gartner 60 to 80% of the market share of that product for the first 2 or 3 years, depending on that overall life cycle of 5 to 8 years, let's say. So being in first certainly pays its dividends, taking on those risks. And the other is if you have a more mature product line or offering, going out to the customers and creating what we call win-win wows with the customers and suppliers to discover contract operating and delivering deliverables strategies. Then the other traditional way, and the simple way to do it from a sales perspective, is bundling. And that's where you package some of your products that are not performing so well on margin with products that do have a potential or do have a high margin, but you get the 1+1 = 3 within your product lines, and you're able to increase your overall margin dollars and at the same time margin dollar growth. So, turning that into money is what it's all about. With that, Greg will get into some of the methodologies. Greg? Oh, sorry. Forgot we had this polling question. I should know it. I put it in. This is a polling question for you all. In what ways you can leverage the risk landscape to create company growth? And we see somebody has entered in start a risk dialogue. I think that's the first thing is start the talking. Don't be afraid of talking about risks. Greg, a few thoughts?
Yeah, you bet. It's pretty basic, but a lot of times, folks, we've seen it over 14 years that company culture sometimes overrides a dialogue of talking about risk, because most often company execs consider risk a negative. They don't think about the opportunity, so that's why we say maybe one of the first things you could do is start broaching the idea of risk within a project, within a new product line, and or within your supply chain, and see how that dialogue unfolds. All right, that's good. Other folks are coming in. Sales and market teams, sure. Start talking about risks out there with your customers. Yep, that's good.
Yeah, and cross-functional is where a lot of opportunities come from, is getting the people in the field, both from an operations and from a sales perspective, in the same room. It's amazing when if you bring this topic up in a cross-functional team, bring some engineers in, bring some manufacturing folks and field people together and talk about this. You fill up the day fill out an hour or two very quickly in ideas on how to take risk and turn it into opportunities. It's amazing.
Mm-hmm. Yep, we normally have seen, and we advocate as one individual. I think Bob just put in a memo in the chat that you can start, and it might be good starting to the risk dialogue within your four walls, but it also is very compelling and very I'll say very compelling if you go downstream to your customers and ask some hard questions about risk, and also start to go upstream to your suppliers and talk about their risks. And so the minute you start the dialogue across your entire supply chain, boy, it gets pretty interesting pretty quick, folks. So, we just wanted to see what your thoughts were associated with this thread of looking at risk to grow top and bottom line. All right. Very good.
Excellent. We'll come back to this at the end of the section. Greg?
Yeah, we thought we'd start a little bit now talking about some tactics that you can start to deploy in terms of helping you grow revenue by mitigating risk and leveraging risk. So this is a product portfolio study done a couple of years ago across the globe, multiple industries. Here's what they found. They found that only 11% of companies constantly monitor or stop underperforming products. I don't know about you, but it's kind of inherent inherent in our supply chain DNA. We are very good at getting new products and existing products out the door. We're very good at that and we get paid well. The issue is we're not very good at getting rid of underperforming, lousy products and lousy customers. I say that, all right? So they found that only about 10% of the people do that in their supply chain. That's got to be fixed. Next, they found 56% said one of the top 3 pain points for us is we operate with too many products with the least amount of with not enough resources. Okay, same basic profile. All right, another one they found was 57% said the greatest risk is missing critical market windows. That's what we're talking about. Why? Because these companies are so bogged down with all their product lines that they're slow on the uptake, and then someone else garners that revenue. Couple more little threads. 45% said they manage product portfolios, all their SKUs with spreadsheets. Not surprised, not surprised. Another one, more than 50% said they're operating with too many products. That's too many stock keeping units. And then finally, 37% said our project portfolio delivery projections are very, very inaccurate because we have too many products and not enough resources to manage them well. So the net is on the bottom here, a methodology needs to be templated and leveraged to drive recurring process improvement. If you don't have a template, you don't have a process, you don't have someone to do it, net only 10% do it. So it's all about finished goods and product proliferation. Let's talk a little bit more about portfolio management. Speaking of SKUs, this is the classic 80-20 rule for product portfolio management. Go right down to the bottom left, and our statement over the last 50 years, no matter who you are, 22% of all your products account for about 80% of your revenue and about 81% of the contribution margin. So if you have substantially different profile, I would certainly love to hear from you in an email. Really, no matter who you are, what you make, what service you provide, this seems to be the way of the world in supply chain management. So the net on this slide is reducing SKUs ignites the risk dialogue. That's why we advocate it. Once you start exercising these tactics, risk will surface. All right. And then you get the dialogue going. There's more. What can you do about your SKUs other than the classic ABC analysis, which is cost of goods? All good. You got to do that. That's table stakes in supply chain. This is a little different picture of how to evaluate those same SKUs. It's called gross margin return on inventory investment. It's genned up about 30 years ago out of the CPG environment, consumer packaged goods. You can take a look at the algorithm real quick. All you need are 2 things: inventory turnover rate and gross profit margin percent. Think of it this way. It's the amount of gross profit you earn for each dollar you invest in inventory over an annual basis. Let's take a look at how the folks graph it. Here's what we do. You can go do it yourself. We do it. Our partners do it. The big 5 do it. They look at all your SKUs. They put them in descending order when they go through the calculation. And then what we and they do is we turn it into a graph, because a picture is worth 1,000 words. People grab onto the graph. Here's what the graph looks like. Here's normally how folks will show you the profile of your SKUs. On the y-axis, we'll have inventory turns, and that's from low to high, bottom to top. On the x-axis on the bottom, we have margins from low to high, and then we have 4 quadrants. Let's take a look. Up on the top left, we call them constant evaluation products. They're yellow. And essentially, why are they yellow? Because they have high inventory turnover, but they have low margins. Down on the bottom left, those are highly suspect, meaning we plot the SKUs. They're red because why? They're low turnover and low margin. Bottom right, we have workable segment. They're blue. Why? Because they have low turns, but they got great margins. And then up on the top right, we have the ideal quadrant. They're in green, and that because they're high turnover and high margin, and you just want more and more of them. And the net is once you profile them by SKU, then you want to attempt over time to move more and more SKUs at or above that 45-degree diagonal line. But it's a new way of looking at your SKUs to mitigate risk and potentially it's an alternate approach to review your SKUs. Risk dialogue will come out. Many exemplars actually start calculating another element in terms of how risky is this SKU, meaning where does it come from a supplier, and on and on and on. We just don't have time to do that today. This is pretty simple. We would advocate your graphic. We do it, partners do it, and so forth. We have some more for you.
So we do have a question coming in here.
Yeah, sure.
I thought it. Let me just get back to it. 1 second. Does reward come from? Shoot. Where did it go? Mark had a question. Does the reward come from taking a risk from finding mitigation faster for a risk? I think we covered that one.
Yes, I think we answered that one, Jim. I thought.
Maybe Mark would. Oh, he deleted his question. Okay, I think you answered his question, but it's basically his question was around what do you do with these guys? You know, what's the risk of abandoning these? This is always the. I think it's a great question because I you know, we had long arguments. Well, we can't get rid of this. They could be attached to. They could be synergistic. This one may be synergistic with this one over here. So if you lose this, you're going to lose that one. So they're sometimes linked. It's not a simple, you're going to get rid of all these.
No, in fact, and we're doing one-dimensional here. This is only your finished goods.
Yeah.
When we talk about customer segmentation, it gets real emotional real quick, folks.
Yeah, it does. Especially
it
if
does,
you were,
yeah.
Especially the old timers. they love their old SKUs and
well, remember, SKUs and customers, your sales and marketing folks, we're not picking on them. Sales and marketing folks are wedded day by day to the SKUs and the customers. That's why it gets emotional, folks, real quick.
Yeah. And then another question came in, and how would you classify low performers that some customers require to support other high performers for certain customers? I think we kind of touch base on that one also. It's a heated discussion.
Yes, it is.
It's a round table. You want a round table, not a split table. A pointed table.
Yepper. Yeah, it gets emotional real quick, folks.
Yep. But you want to look at all those things. But with that, we'll move on, Greg.
Yeah, we'll move on. And now we'll talk about customers. This is what we call customer value management, another technique to mitigate and potentially grow top and bottom line. So just think about on your customers, revenue alone is somewhat of a misleading indicator of customer value. Again, it's the 80-20 rule down the bottom. 20% of your customers will generate 80% of your profits and contribution. It's classic, 50 years, it has not changed. If you have a different profile, I would like to hear about it through the email. Let's take a look. What we talk about is customer segmentation driven by what we would say is lifetime value. It's called CLV, customer lifetime value. But essentially, we advocate breaking your customers into 4 segments. If you don't do it, here's a little guide. This will guide you in terms of who they are, why they are, and how to mitigate and how to grow. Number on the green, we have champions. You have champions as customers. What defines a champion? They give you high revenue and they're a low cost to serve, which means it's not a bad margin. What do we advocate there? You got to nurture them, grow them, look for more, grow your product line throughout the champion. But boy, champions are great. Next segment are what we call demanders. What do they look like? Well, they give you high revenue, all right, but they have a high cost to serve, meaning they might have penalties, they have windows for delivery. So it costs you more to deliver product to those demanders, all right? So what do we advocate there? Grow those demanders and attempt to reduce the cost, which is really mitigation. All right. Third type of customer, we call them acquaintances. What do they look like? Well, they give you a lower revenue, but they have a low cost to serve. All right. So, it's mitts of mitts. It's 6 of one, half dozen of another. What do? Maybe you grow the revenue, try to grow the volume because they're a low cost to serve customer. And then finally, we have what we affectionately call the losers. They're in red. Why? Because they have low revenue, very lumpy, and they have a very high cost to serve. So potentially every time you ship to them, your accountants will tell you that you lose money. But as Jim said, the losers, there might be products associated with a loser, and they also might have a very good product. So it gets very emotional real quick. Our approach to you is to improve the profitability. This dialogue and tactic will again surface the risks by customer. And if you think of it this way, if you don't segment your customers now, and you don't treat them differently in a supply chain delivery, you're leaving money on the table, and your supply chain and your resource folks are at risk. That's why we advocate customer segmentation. One more I think we have for you to tie it all together. This is called total cost to serve. You may be familiar with it, you may not. TCS, it brings the customer segmentation dialogue and tactic and the product portfolio dialogue and tactic together. And here's what we do, here's what our partners do, and the big five do it as well when they really look hard at your product portfolio and customers. On the y-axis on the left, you have product classification on margin. And real simple. The A and B customers are the good guys. The C, D, and E are the dogs and cats as it relates to product margin. All right. Up on the top x-axis, you have customer classification on margin. And again, A and B, the good guys, C, D, and E, the dogs and cats. So on the top left of the 2x2, you have a very profitable arena. You have A and B customers who buy A and B product. On the bottom right, at the coal area, you have very unprofitable pictures, which are the dogs and cats of the product line and the dogs and cats of the customers. So what do? Well, here's what we advocate, and so do our partners. You start to look hard discussions in the bottom left-hand quadrant, which is called the copper quadrant. All right. What are they? Well, on the top, they are the good customers. They're your good A and B customers, but they also buy the poor margin product. So it's a hard discussion you got to start, and we call it tweaking. You got to tweak the combination of product and customer. Over on the right-hand side, bottom right, is the coal. All right. Well, now think of it. These are the very low, poor margin products being bought by very tough customers, either acquaintances or losers. All right. So what do we advocate here? We advocate that you shove. You got to start shoving this combination, and we have a 45-degree angle line where we actually advocate you got to attempt to move those combinations of products and customers towards that 45-degree line. And but you got to focus on the two bottom quadrants, and those are very difficult and emotional discussions, folks. It's not easy. And I'll give you one more recommendation before I pass it to Jim. Don't do this tomorrow. Do not do total cost to serve tomorrow. All right. Do your product portfolio first, then start talking about customer segmentation. And you have to have some gravitas in your company. You need to be trusted before you do total cost to serve. Trust Greg. That's what you, so wait, do product portfolio first, see how it plays out. Talk about segmenting your customer under the risk of, under the guise of risk management and growth. Because why? Why are we advocating this? If you get rid of poor product portfolio margin products and maybe get rid of a couple of poor customers, what do? You free up your capacity to make more good products for good customers, higher volume, higher margin, and you can spend more time on less SKUs and customers. That's the key. With that, I'll pass it to Jim.
So that floats perfectly into asking yourself, what type of company are you? And what is your operational propensity? Or in other words, we say, what's the shape of your kite? So to facilitate this risk discussion, as Greg has just shared with us, that is bound to come out of these discussions. So the long pole in the tent, so to speak, the bottom of the kite here is agile, and opposite is bureaucratic, trapped, and startup. These are the personas. And again, this is based on the framework by Kim Cameron and Robert Quinn back in the late 90s, early 2000s. We took that, tweaked it a bit, and we're going to focus on the personas. We have whole webinars just devoted to this tool, but for today, we'll just look at it at a high level. Again, the agile type of persona is a company that has a dynamic entrepreneurial risk-taking, values innovations, very creative oriented. Moving to 90 degrees here, the startup company is more entrepreneurial, market-based, results-oriented, gets a job done, and values the competition. So again, as we were talking, Greg was talking about mixing your product portfolios and so forth. You can see when you're a brand new company, you're in a startup mode, you're going to be focusing on different things, and the culture and how you operate will be aligned to that. The third is bureaucratic. The top, generally bureaucratic companies have been around for quite a long time. They have a lot of structure and control, coordination, and they generally have fairly mature product lines in general, but they may have some startup divisions. And then the last is what you saw really coming out of the tech area from 2000 on is companies that are more clannish, siloed. Clannish not in a bad way. It's just that they're very focused. They're very collaborative within their division, but cross divisions, they may not be so collaborative. So it's not a right or wrong, but you should know what type of company you are while you're in these risk discussions, so that you understand how to manage these things, especially the executive leadership. Again, there's no right or wrong here. It's just understanding your constraints. With that, we'll go back to the survey question here, and we see a few more entries. We're getting close to the top of the hour. I love the feedback here. Customer risk profiling, acceptable, acceptable environment to have these discussions. What's acceptable, what's not acceptable is a point of perspective, and bringing in all those perspectives to have that rich risk dialogue, and you guys, your teams can come up with solutions.
Mhm.
Greg?
No, you bet. It's all good. You got to start somewhere, folks. And we would advocate starting within your four walls to start talking about risks. And we wanted to share with you a couple of pretty simple tactics you could start to try to get that risk dialogue going and see what kind of flavor, as Jim said, what's your company's risk appetite? What's the culture? You need to understand that before you move forward on your journey. So all good there. Thanks.
With that, the case studies,
Yeah, we got one
Greg?
case study here. I think Jim has another, just a real quick one. This is a chemical company's approach. They use supply chain mapping, scenario planning, risk mitigation, and they did what we talked about in terms of customer segmentation and product portfolio. So the challenge was, can their existing supply chain support an exponential growth rate in a new country? They were trying to go somewhere where they haven't operated before. The opportunities were to think of it, grab new market share in a country where you've never operated before. And that to them also begged this question of redesigning their supply chain to drive this new tremendous growth, reduce costs and improve margins. So that was the challenge, their opportunities. What methodologies did they go through? Will be pretty quick. They digitize their supply chain, as we always advocate. They developed somewhere around 40 demand level scenarios. They put probabilities associated with each scenario. We helped them do that. They appended a risk to each scenario using tools and techniques that we advocated. We actually utilized design of experiments, the Six Sigma methodology, to tighten up the statistical models, and then they reinforced the model by utilizing sensitivity analysis curves to try to make sure they understood where the tipping point was from the output of each model. The net through simulation, through product portfolio management, segmentation, supply chain mapping, what'd they do? They reduced their lead times to the customer by 35%. They improved their capacity utilization, which if you do that in chemicals without buying additional equipment, you are a hero. They improved their service levels, and guess what? They garnered about 30% of that new market in a very short period of time. So it can work, folks. With that, I'll turn it over to Jim.
Thanks, Greg. So this one is on a startup company, our startup division within a very established company out there, a 3PL moving to a 4PL model. And it was a very dynamic call center when we started. Everything was account management based, focused on companies and managing their supply chains. And we had a fairly good employee satisfaction rate, but a very young, demanding workforce. The challenges, again, it was a first of a kind new business model. The products were not very mature, high growth rate for the ones that were working. The cost of services outstripped revenue for some of these services. We had too many SKUs when we came in. We reduced those dramatically and honed them in to drive profitability and scalability. And then we had some Fortune 100 companies and one Fortune 1000, some very large companies were under the radar for us as key clients. And then we had our carrier relationships that we were managing. The results were pretty powerful. Within 2 or 3 years, we transformed that customer mix, as Greg talked about. We honed in on all the services that we were providing that were unprofitable. We did a lot of the bundling there of fixing products where they were not profitable and then combining them with others so they became profitable. The 1 + 1 = 3. And we also had to rewrite contracts. And then at some time we went through the process of removing a few customers, but not removing them. So we called it promoting the customers onto somebody who could better serve them. So we wanted to keep our customer satisfaction rate high. So we were able to move that from 2.5 to 5, as well as supplier and employees. And all net, we went from being an unprofitable division to being 20% growth through the recessions and at 20% net income, and became one of the most desirable places to work in the overall company. When I came in, not many people wanted to work there. That's why the young workforce. And the CEO came in after we were up and running after 3 or 4 years, and he said under his breath, he said, "Well, we're going to shut you down, but now you're a profitable business. Congratulations." With that, what can you do now, Greg?
You bet. We'll kind of do a little recap, but what can you do now? One, we would advocate you go through our supply chain management readiness assessment. It's free. I'll give you a quick profile in a minute. You might want to think about supply chain mapping, digitizing your supply chain, or just putting it up on a wall. We do it for clients. We do it for gratis. All we ask is to get there. It's kind of a morning session. You pick a product line and we put it up on the board from customers all the way to suppliers. It's a wow factor. It surfaces the risk. It's a very compelling short exercise. Business continuity planning, a little different. BCP, that takes a couple of days. That's where you do scenario planning, tabletop exercises, and you put scenarios together verbally, and then you write them, you post them on the board or on the system, and then you start to develop some mitigation plans. On the other side of the ledger, we talked about PPM, the 80-20 rule. We talked about CLV, customer lifetime value, which is segmenting your customers. And we gave you a profile of putting those two tactics together called total cost to serve. All right. So again, these techniques work to do what? Free up your capacity, both resources and assets, to improve top and bottom line, folks, and surface risks in terms of getting growing the top line. We said we mention our assessment tool. Here it is. It's an online assessment tool utilizing AI ML algorithms. It is 13 tenets. You can see the tenets on the chart. The blue are strategic, the red are tactical, and the green are operational. Essentially, it measures what? Two things. It measures supply chain process maturity, excuse me, and inherent risk. All right, how does it do that? Well, if you look at it, the closer you are to the center of the chart, the more mature that particular supply chain process is, and the less inherent risk you have. So what are we looking at? You can look at the black line. That is a company's profile. They've answered the 92 questions. That's their as is condition. What we also show are 3 circles, 3 rings. The green is where exemplar companies operate, both from maturity and risk. Then you go out from the green ring through the orange ring. That's less mature and more risk. And then we affectionately call the red ring the ring of fire, meaning if your processes are out there, they're very immature and they are definitely at risk. So essentially, we always use this as a starter. Folks, it's free. The assessment link is up on the top. It's free. As you get some time, go in there, take a look at it, give it a try. Go in there with your team, not your peers yet, your team, and go through maybe a group discussion and get a sense of how mature your supply chain processes are. And that will surface some risks as well. So we wanted to share that with you. And with that, we'll move into our last section, which is kind of a roundup or a roadmap and some takeaways. So I'll give it back to Jim.
Thanks, Greg. And we all know that everybody wants to have ways to measure risk and your risk impact priorities. And this is benchmark from our friends at Gartner, Chainalytics, and the Hackett Group on what it means to your bottom line in increasing performance from laggards to average to performers, and followers to leaders or exemplars. So some of the ones that we talked about today, top line growth, you can start seeing that type of growth, developing new product features to de-risk the customer operating environment to use your product. So there's a lot of opportunities in that revenue sector. From an EBITDA perspective, earnings before interest, taxes, depreciation, and amortization. From a cost to serve, you can develop alternative products with reduced costs that serve customer needs, addressing over-designed product offerings. Sometimes we're offering things that we don't need to be offering. They're not the customer doesn't give us any value, and that can be a very good area. From a RONA, a return on net assets, higher inventory terms than your peers. You can have some preferred suppliers from a reduced risk, maybe some dual suppliers to support you there. And then your cash conversion cycle. Cash is king, as we know, especially today's world with rising interest rates as we have them. Identifying risky suppliers and identifying contractual terms out there. And of course, on time and full, if you're able to react faster than your nearest competitor and turn that into a revenue stream, that's certainly going to help you on your cash, as well as OTIF, and your being able to deliver if you're making impacts on your deliverables. So again, these are just some guidelines, some metrics that you can put into your environment and come up with those scenarios where turning risk into opportunity works best for you. With that, Greg, close us out.
Yep, you bet. Pretty impressive statistics, folks. We thought we'd wrap it up with a roadmap to resilient enterprise, kind of revisit the theme, creating company growth by leveraging risk. What did we talk about? We gave you a sense of the readiness assessment. That is free. As you can take time to go through it, takes about 20, 30 minutes to go through, but that's a free assessment for you. Next, we talked a little bit about supply chain mapping and network analysis. If you'd like to do that, we facilitate those workshops. Again, it's a wow factor workshop, meaning it starts to surface the risks associated with a small product line. Next, we talked about product customer rescaling, segmentation of your customers, and evaluating your products. That's going to improve your top and bottom line, and it also service risks. And then we talked a little bit about risk assessment and scenario planning. That's under the guise of maybe business continuity planning. That will also surface risks, and that leads to mitigation plans. All right. We advocate that. You do the scenarios, and then you develop mitigation plans, ultimately revolving into the resilient growth area of top line, bottom line improvement. So with that, that's a wrap up. I'll pass it over to Jim for closing.
So we hope we found the webinar interesting and intriguing. Please do follow up with us on our deliverables today, or anything to do with supply chain risk and resiliency. we want to make sure that what we got out of this webinar is how to transform risk into margin growth. Hopefully you're more comfortable with that concept now today than you were when you started this webinar. With this, this is the closing webinar in our series on building a resilient enterprise. We'll be starting a new series in August when we resume after the summer. Thank you again for attending today's webinar and sticking in with us. We appreciate it. Greg, your closing comments.
Yeah, you bet. Thanks a lot. The exemplar companies in risk management, folks, they leverage their risk programs and their high resiliency to do one thing: garner additional sales. All right. The actual chief risk officers of those companies actually go on sales calls to boast about the company's resiliency. So remember, also today it's D-Day, folks. All right. Those brave men leveraged the risks at hand, and the reward was keeping the world strong and free. So never forget them, folks. Thanks a lot for attending. All the best.
Great last words there, Greg, on D-Day. Yeah, we have to really reflect upon what they did for us. And if you watch any of the programs on the risks that they took, how they built docks, how they built planes, that the first planes to bring in people over lines, over the lines into the German territories with no engines, the gliders. They came up with all sorts of things, and they took on risk, and they were able to get the rewards for us all. So that's, I think, an apt way to end the webinar. Thanks, everyone. Bye-bye.